Hello, and welcome to this review of the second quarter market and economy. My name is Charles Thomas from Intrepid Eagle Finance, and I'll be walking you through this today. First, we always like to take a look back and look at some things that happened positively in the last quarter, but also some reasons that we want to keep an eye on that may be concerning. First off, on the positive ends of things, unemployment, as measured by the government, has been at lower than 4% for 30 months in a row. Went up slightly in June, but even still, that's a long run with very low unemployment. When we look at measures of the economy like GDP, that growth in the US still has done very well. When we look at May, the CPI, one of the biggest measures of inflation that are out there, it's a step in the right direction from what we saw in May. And then look at the stock market, even with a very high concentration with the top 10 stocks, the S&P 500 still delivering earnings on average. We'll talk more about all those things in a few minutes. Now, looking on the cautionary end of things, is the consumer in America starting to show some challenges? Well, maybe. Our economy in the US is very consumer based. About 2/3 of the economy is tied directly to us as consumers. And we've started to see some higher delinquencies on credit cards and car loans. We'll keep an eye on that. Inflation, although it has improved, is still very high historically speaking. When we see that as improved, that's been good. The goal that the Federal Reserve has set is to get down to 2%. We still got a long way to go on that. We'll talk more on that in a few minutes. When we look at the top 10 stocks in the S&P 500, they're very concentrated. The vast majority of the return that investors saw in the second quarter came from information technology. We'll dig into more of that in just a few minutes. Now, looking at the second quarter, some numbers to share: 5.25% to 5.5%. That was the Fed's policy rate that they set in July of 2023 as part of their campaign to get inflation under control. And it hasn't changed since then. It's the highest rate we've seen since 2001. It froze there, and they have not made a change ever since. The next number I want to share is 1. Now, that's the expectation of how many rate cuts we're going to see this year. And that's so significant because it wasn't that long ago we were hearing all the prognosticators and all the experts and a lot of people at the Federal Reserve themselves say 6 to 7 rate cuts this year. To go from 6 to 7 all the way down to 1, that just shows you what a challenging environment this has been for them for their goal of getting inflation under control. Speaking of inflation, when we look at numbers there, 3.3, 2.6, those are the headline numbers that we saw from inflation in May. That's compared to 3.4, 2.7. My takeaway there is things have improved, but we've still got a long way to go. 37%, that's the amount of the top 10 stocks in the S&P 500, how much they make up. The reason why that's significant, that's the highest level of concentration we've seen there at the top of the market since going back to 1996. And it's well above what we saw around the early 2000s during the internet bubble. So that's starting to be something that becomes more and more of something to watch. When we look at the S&P 500 for the return, that was a little over 4% for the second quarter. A lot of that came from the technology sector. We'll explain more of that in a moment. And then 15.3%, that's the S&P 500 for the year to date through June. Now, if I take away just one stock out of that, NVIDIA, then that return would have been 11%. That's how much of that return has been concentrated to the tippy top. Looking at inflation, we all know inflation has been very challenging for everybody the last couple of years. But even looking back, not so far, back to 2022, that's when we were at the highest levels. We've come a long way since then to getting back to normal. We are not back to normal yet, but we have had significant improvement since that level when we were at 9% not too long ago. Now, one thing I wanted to show you with this chart is just how inflation components contribute to things. Because as you know, not everything goes up in lockstep when we think about price increases related to inflation. Different things go up at different times. So back when we were in the doldrums of 2022, everything was going up significantly. One of the big drivers there was energy. That was a big thing. We've gotten to a place now where energy has no longer been a big driver as of late to inflation, but we have seen other things tick up like auto insurance. So if your car insurance has gone up in the last 12 to 18 months, it's not just you. That has happened across the board at a very high levels compared to what we saw for the last decade. That has gone up. We've also seen it in other places like dining, recreation, shelters, so housing. Those things have all been big contributors there. Hopefully, this will continue to get in a better direction. Now, I talked earlier about the expectations versus what has happened with cutting interest rates. When we looked in January, we were having this conversation. The conventional wisdom was the Federal Reserve was planning and signaling to everyone that there was going to be 6 to 7 rate cuts throughout the course of this year. As the year has gone on, that has gone lower and lower and lower. And even last quarter, when I was doing the same presentation, they were still talking about 2 to 3 rate cuts throughout the rest of the year. Now we're down to 1. And even that is a maybe. As I said, we've been stuck at these levels for a long time because the Fed is very reticent to change rates and let inflation get going back in the wrong direction again. Now, as you might have noticed, we are in an election year. And the Federal Reserve is ultimately a part of the government. So the question comes up, do they change their behavior in a year like we're in, whereas there's an election year? And what does that look like? Well, instead of going off what someone says they're going to do, I'd rather go look and see what their track record is. Let's go and see what that has done in the past. And when we break that out by election years, inauguration years, and then all the other years, it's split very evenly as far as what the Fed is doing to adjust rates. They're not taking the year off, but they're also not going out of their way to do a lot of activity based on that either. Again, as measured in the past. Do they have to do the same thing this year and going forward? Absolutely not. But more often than not, history doesn't repeat itself, but it often rhymes. And that would be a reasonable expectation going around for this time. So we shall see. Looking at the markets and what those done, first looking at what global bonds did. Bond returns were mainly positive for the second quarter, with the exception of 5 to 10-year municipal bonds, which were down slightly. Treasury rates rose slightly over much of the time due to current yields. The income was able to compensate for the difference in prices there. Rates rose as inflation remained stubbornly high, and the Fed signaled they're going to keep interest rates higher than longer. When we look at it, non-US bonds, they continue to be a very positive contributor, having returned a little over 5% over the last 12 months. Now, you might have heard in the financial press or elsewhere the concept of yield curves. And what that is on these charts, it's showing the difference in the kind of interest rate you get from a bond based on how long a term the bond is for. Now, in a normal environment, the longer I, as an investor buying a bond, am willing to lock up your money for, the more I can expect to be paid for that. So shorter time, lower rate, longer time, bigger rate, more interest. When you have a yield curve that's inverted, the exact opposite happens, where I'm getting actually paid a little bit less for locking up my money longer in a bond. And that's what we see with that. And it's even when we look out across internationally, it plays out very similar. So you look at the United Kingdom, United States, the EU, very, very similar the way they look. But it's not that way entirely. But pick this chart out because it shows Japan. Looks a little bit more normal when we look at that. And that's one of the reasons why, even with bonds, we think about diversifying to an extent outside of the US and what that value is to us. Now, another thing you will hear out there is there's this rule of thumb when it comes to the inverted yield curve concept we just talked about. There's this rule of thumb that means a recession is going to happen. Well, the problem with rules of thumb is sometimes they're right, sometimes they're wrong. So what is the deal in this case? So in this case, the chart above spells this out very well. There's been lengthy periods between a yield curve inversion and the next recession. It doesn't always mean it's imminent or even connected. So if you look at that bottom row, not only is the predicted recession that everybody was very sure we were going to get because of the inverted yield curve, not only has it not occurred, but the stock market has been positive during the period as well, being up almost 13% through April of this year. And this is just one more case where I try to tell folks the economy and the stock market are different things. Just because one does one thing, that does not mean that the other has to follow in lockstep. They are off in the very, very long term. Yes, they are very related, but even just year to year and certainly month to month, they are often disconnected in what you see there. And the final takeaway I would say here, this is just one more reason why I would say those rules of thumb, while they can be interesting, they're not rules to live by. Another piece that I want to share with you, just thinking about what interest rates look like. We've gotten to a point where yields in money market funds and certificates of deposit have gotten up around 5%. And once we get above 5%, that's this magic level for a lot of people, just mentally, where it can be very tempting to go put everything you have in cash because it's doing much better than what cash has done the last couple of years. So the thinking a lot of people have is, well, I'll sit there until interest rates go down, then I'll buy something else like stocks or bonds. What would that look like? And while that can be attractive, while that interest looks pretty good, what can happen is you end up missing out on the benefits of being invested more longer term. That's what can happen. Markets can often move ahead of Fed decisions and anticipate those. So you end up missing that. And I wanted to share this chart here showing that's what things have looked like in some of those previous rate cycles. Stocks and bonds in different combinations have generated much stronger returns compared to 6-month CDs in the 12 months following those peak CD rates we saw in the past. Looking toward US stocks, they were mixed for the quarter. Most are up year to date. And if you look at the last 12 months, everything was higher with it being at least 9% or higher, which is fantastic. It's important to recognize how strong these one-year returns are. If every year was like the past 12 months, I would be very happy. The average annual return for the S&P 500 hovers around 10%. And so some asset classes are all just well over that in just the first 6 months of this year alone. We have no way to know if that's going to continue, but we celebrate it nonetheless. Now, one thing I'll point out here, particularly that highest bar you see on there, it's what we call large cap growth stocks. And I want to tell you more about what's going on there. When we look at the S&P 500, it was just completely dominated in the second quarter by technology. And when we look at the overall return, 4.08% came from that compared to the overall return of 4.28. And then to take another spin on it, tech was the only sector that contributed more than 1%. And then if you look at another way to look at it, 6 of those 11 sectors were negative for the quarter. That's just how important technology was for that second quarter. Now, I've talked in past presentations about this concept, this term that has come up because this top 7 stocks in the S&P 500 have done so well. They've taken on this moniker called the Magnificent Seven. And we look to that strong start we saw for 2024. The majority of that return came from just 7 stocks. They've returned about 33% through June, while the rest of the S&P 500 returned about 5%. It's that much of a disparity. Now, average person you could forgive them absolutely for thinking, well, if they're going to outperform, why wouldn't I just buy those 7 stocks? Why wouldn't I do that? If they've done this well so far, that will likely continue, won't it? Well, here's what that has looked like in the past. So if you look at and use history as our guide on this, since 1990, roughly 4 of the top 10 S&P 500 stocks by market capitalization fell out of the group in the following 5 years on average. In other words, when you diversify, that's the value in that. Just what's on top right now does not have to stay on top. If you look at the same S&P 500 top 10 holdings from 5 years ago versus today, there's 3 that were in the top 10, Johnson & Johnson, JP Morgan, and Exxon, that are no longer included and have been replaced. If you go back 10 years, only 3 of the S&P 500 holdings from that time, Microsoft, Apple, and Berkshire Hathaway, are still in the top 10 now. The other 7 stocks that were previously included have all fallen out. And so that's why what is in favor right now does not have to continue to be in favor. Keep that in mind. Now, to take another spin on that, because technology stocks have done so well, you might think, well, it's only tech stocks that are doing well. It's only that. Well, if you go dig into this, although that's where a lot of the returns has come from, there's still a lot of stocks that are doing well that are outside of technology. I put up some examples here about other places that are in some of the less exciting industries like industrials and utilities. And although a lot of the returns have come from there and a lot of the size has come from there, there's other companies that are doing well. And that's why we continue to believe that owning broad-based diversification is important. Now, looking at those US large growth stocks, what does that look like? Well, about 37% of that comes from that top 10 we talked about. And this is some of the highest this has been in quite a while. We think about that concentration. The index is heavily influenced by what happens with just a handful of companies. So keep that in mind. If you're watching some of these different measures from time to time, the more one stock takes up of that, the more their fortunes are tied to whether those are going to show up or down. Looking outside of the US, when we look at developed markets, they were negative for the quarter, and emerging markets were positive for the quarter, being up about 5%. When you think about the difference of those, think about developed markets being places like France, the United Kingdom, and Japan. Emerging markets being places like Mexico, India, Saudi Arabia. It goes further than that, but that gives you a flavor of what that looks like. Now, a lot of people might look at those returns compared to the US counterparts and simply think that the non-US companies are not keeping pace, but there's a little bit more to it than that. Went and took a look at the top 50 companies across the globe and broke that out by country. And although we're doing very well in the US, we contribute to that. Beyond those top 11 that belong to the US, that's the other 39 are spread across the world, coming from India, China, South Korea, and so forth. Lots of other places. So growth is not something we have a monopoly on in the US. If we look at that even a different angle and put that technology hat on again and see what that looks like. Are those gains in those top 50 companies only coming from technology? Again, answer is no there. Even internationally, that is spread out beyond just technology into a lot of other industries. And while there is that concentration we talked about earlier, looking from this lens, this is a more positive angle than that gains are more democratized than we might think otherwise. Thinking about the US dollar, this chart I'm showing you here is a measure of the US dollar's strength compared to a number of other currencies around the world. There were some times during the second quarter where the dollar was a little bit less strong than it has been. Historically speaking, and over the long term, the dollar is still about as strong now as it ever has been. Still very, very strong. Now that has a double-edged sword for us. As consumers, that's a very good thing for us. It means our dollars go further at buying goods internationally. As investors, it's less good because our international dollars invested, when they come back home, they're worth a little bit less than they would be otherwise. That sword cuts both ways. It's good to know. But even with all the talk around this, the dollar continues to be very strong. Will that continue? Will that continue over the rest of this year? Will that continue with the possibility of the impact of an election? We shall have to see. But for now, for the time being we're in, dollar remains very strong. And as we get to the end here, just a couple of things I like to share as reminders. Financial planning is a process. It is not an endpoint. We're never done. We're continually working through this, continuing to digest new things and new information as they come along. Focus on long-term goals and objectives, not short-term blips on the radar. Focus on reaching goals, not on benchmarks. Maintain a disciplined approach in good and bad markets. Invest broadly and globally. Asset allocation is key. Reduce investment and tax costs where possible, and then rebalance as necessary. And so as we near the end here, I thank you for your time and your attention, and I hope the Lord blesses you and your family. Thanks, and have a great day.